there's kind of three different parts of depreciation I want to talk to you about. By the way, this is good. We're going to be talking about Form 4562, which is in here on page 9 and 10. And then there's actually a schedule a little further in the back on 14 that also kind of gets a little more detail on that. Three different areas of depreciation I want to talk about. The first one is kind of easy, and that's equipment. And that can be computers, that can be cameras, video equipment, musical instruments, you know, anything other than a car and your house, which we're going to talk about later. So those expenses can be, the new tax law was very good for businesses and allows you to take 100% of the deduction of any equipment that you buy during the current year in this year. So that's a good thing. You know, you buy a laptop, you can deduct the whole cost of it this year. You don't have to, but you can do that. And most of the time, if you have income, you want to take the deduction now because you reduce the taxes you pay now. So that's a provision that you want to take advantage of. Yes. First of all, the easiest answer is just to write it all off of the year that you buy it. But you don't have to do that. And the way you determine how long to write it off is that the IRS tells you how long you can write it off. And so for electronic equipment and equipment that is of technical nature, you can write that off over 5 years. For all other equipment, musical instruments are one, frames or storage, I'm losing the term, but whatever, racks, storage racks or whatever, no, whatever. Everything other than like electronic equipment would be 7 years. Basically, the first year, you can write off 20% of the cost of a 5-year piece of equipment, and in a 7-year equipment is 14% approximately. But there are tables. Basically, most of us, if you're making money, normally you want to write it off all now so you get a deduction for it. But there are reasons why you might not want to do that. You know, where you might want to take depreciation. A couple reasons would be maybe this is a really low income year for you. You know, you're first starting out and you didn't make a lot of money, you made some but not a ton. And, you know, next year you're going to be in a higher tax bracket. So then the deduction for that equipment will be more beneficial later in taking in future years. Software is something separately that's written off over 3 years. Now, if it depends on the software. I mean, if you're buying, you know, Office or something like that, I usually just write it off all in one software. But if you're buying a major couple $1,000 program or something like that, that would be over 3 years. Unfortunately, no. So you have to sort of follow. That's a good question. You have to follow that along, and so you will continue to write it off over 5 years. So once you do it this year, you have to write off for the several years. So basically, again, one reason you might not want to write it all off this year is that your income is going to be low. Another thing is sometimes maybe it is a big income year for you, but on your Schedule C, you don't have a lot of income. But you know you're going to make more money in future years. On Schedule C, and we're going to talk about this later, but there's something called self-employment tax in addition to your income tax. And self-employment tax is basically Social Security that is normally taken from your paycheck. So sometimes this year you might not have self-employment income, and if you take this deduction, it's not going to ever reduce self-employment income if you take it all this year. Whereas if you depreciate it and take it over several years, then you'll be able to reduce your self-employment tax in future years by that amount. Most, I'd say with my clients, 93% take it all in one year. So when in doubt, take it all. And it's a lot easier to compute and such. So, you know, that might be your answer right there. So that's on equipment. Everything but cars and houses. We'll do houses next, which it's easy. Houses are written off over, for business use, 39 years. So you take, you paid, let's see, you paid $390,000 for your house. You write it off over 39 years. You would get a depreciation of $10,000. That's if you use your house 100% for business. So you still have to take the business use percentage times that depreciation figure. So, you know, normally you're going to take maybe 10% of your house for business, so you would only be able to deduct 10% of that figure I just told you about. So that's housing. Real estate you have to depreciate. However, if you're making improvements to a commercial property, then you can take, you might be able to take 100% of some of those costs. And this is usually in, you have an office building or something like that. But right now you can't actually, because there was a law that was supposed to be passed and it hasn't been passed yet. So we're still waiting to see if that's been passed. But, all right, finally on cars. Cars, again, we're getting back to how, depreciation expense for that. You can write off cars. There's tables for that. Again, in the instructions to Form 4562, basically, cars used to be very limited in the amount that you could take for depreciation on them. And that's changed somewhat, quite a bit actually, in 2018 and beyond. You can take, used to be you could only depreciate the cost of a car up to about $16,000. And now it is roughly about $50,000 that you can take a depreciation on. And in the first year, if you buy an expensive car, you can actually write off $18,000 of the cost of the car, if it's an expensive car. So a little bit beyond the scope of things, but basically cars are written off over 5 years also. And there are tables, again, for cars that are in the 4562 instructions. Next, travel, meals, and entertainment. Let's talk about entertainment first. You may have heard, and it's true, that you can't take a deduction for entertainment anymore. So entertainment would be, I take a client out to a baseball game or a movie or you know, the opera or wherever. You can't take a deduction for that. However, for you guys, not for us regular folks, but for you guys, a lot of times what most people would call entertainment is really kind of research for you. You know, you're going to a concert. You know, you're a filmmaker, you're going to movies, or you're watching Netflix or something like that. Those are actually not considered to be entertainment expenses, which means that they still are deductible. And in the old days, meaning before this year, you could only take 50% of entertainment expenses. But again, since these are not entertainment expenses, you actually can take 100% of it. If you're a visual artist, you know, you can certainly go to museums and stuff like that. Music, not so much probably, at least going to concerts. But a lot of creative people get input from all media. And so, you know, that there can be the case made for that you can take pretty much everything that is media related. Again, it has to be in your field, it has to be necessary and for your business. But if you know, if you can justify it, then you should be able to, you can deduct. Let's talk about documentation. I think this is a good time to do that. You know, documentation is going to be an invoice and then sort of the method of payment. So a lot of times, you know, you're going to charge it by credit card. So you really should get your charge slip. You should have the receipt, the cash register receipt, and then you show your credit card statement to show that you've paid it. So you sort of show it 3 ways there. The cash register receipt, the charge slip, and this is if you charge it. Obviously, if you don't charge it, you pay by check, and you have your check. If you have by cash, you don't have that, but you know, you can still pay by cash. And what you do with cash payments then is you should have a contemporaneous notation of what you did. So either in your calendar or your logbook or something to show what you paid. The best thing is to not pay as little as possible by cash, obviously. But those are the documentation. Entertainment, meaning again, when I go to the ball game or something, that's out. That's not a deduction. But for you guys, a lot of what other people would call entertainment is not entertainment. Next, we have meals. So there's a couple different types of meal. I mean, there are a couple categories. All meals, by the way, are only 50% deductible. So that's the rule first off the top. And then they are deductible. For the documentation, meals especially have a higher level of documentation that's required. So what you need to do on meals is that you need to say, well, you need to know the amount and where you were, and then you have to have the business purpose of the expense, and then the relationship to the person you're taking out that you're paying for. So the in-town things have to be with someone else, and even like you go to a conference, but if it's the same day conference and you have lunch, and a lot of times you're probably going to be talking to people at the conference that share similar. You're talking about business anyway, so you could probably take a deduction there. But if you're just sitting by yourself because you're tired or whatever, then you don't get a deduction for it that way. To qualify, again, for the entertainment, or not the entertainment, for the business meals, you have to have a substantial business conversation before, during, or after the meal. So what I do, I try to charge everything on that. On the back of the credit card, I write down, who I was with and what we're talking about, which is always taxes, which we do. Well, I mean, I don't take every meal, but for the ones that I do deduct. So that's the in-town meals. Okay. Then, if you travel away from home overnight for business, then you can, whether you talk to anybody or not, if you're by yourself, then you can take the meals that you spend for business. Or, I'm sorry, you can take the meals that you paid for as a business deduction. Okay, so I tell you about you certainly can deduct the actual cost of your meals. But you want the good documentation, the receipts and such. There's a fallback position, and that is, rather than having the actual expenses, if you can substantiate that you were out of town for business, legitimately, then there's what's called a per diem rate, and that varies by city, and it's generally somewhere between $50 and $75 a night, depending on the size of the city. New York City is high, Missoula, Montana is low. So on that website, which is easy to find, it's got several columns. And what you want to use is what's called the M-I plus E, or and E it actually is. And that stands for meals, incidentals, and, meals plus incidental expenses. It's M plus I. And so that, in the column, there's going to be several columns that are going to show for lodging. And then it's on the far right, as meals and incidental expenses come up. That's the one you want to use. As a self-employed person, you can't take, we're going to talk about this in just a second, but you can't take lodging expenses based on this per diem. It's only for meals. For lodging, you're going to have to use the actual expenses. We'll chat about this more later. But even with that table, you still only can deduct half of that amount. So it'll say $74, but your ultimate deduction is only going to be half of that. We got about 5 minutes. There's a couple other areas I wanted to hit on that are important. One was that self-employment tax that I talked about. So when you're an employee, you get a paycheck, you'll have two things of payroll taxes taken out. One is Social Security, one is Medicare. They total up to 7.65% of your salary. A lot of people don't realize that the employer also has to pay in the same amount of money. They match that to the IRS. And the total is 15.3%. Well, when you're self-employed, because nobody's paying any taxes for it, you have to pay that, both halves of that, as what's called self-employment tax. It is basically for Social Security and Medicare, but you do have to pay that on your net earnings from Schedule C. That form is Schedule SE, self-employment, and you follow the form and you pay your tax. As I said earlier, a lot of times, especially if you're making a modest amount of money,
the self-employment tax may be more than your income tax. So it's something that you definitely want to consider, especially if you're just starting out and you've never been paid with it before. You are going to get it. So beware. Final thing I wanted to talk about was estimated taxes. So again, when you're on W-2, you have your income tax withheld from your paycheck, so you don't have to worry about estimated taxes. But if you have earnings that don't have taxes withheld from them, then you have to pay estimated taxes. Those taxes are due quarterly. They're due April 15th, June 15th, September 15th, and January 15th for the subsequent. They're paid on Form 1040-ES. I have a sample of that. It's like a little voucher card, basically. And that is, I think, page 12. Page 12. So basically, pay those quarterly. It's especially, again, when you first start out and you're not aware of this, it can be a real problem because you owe some tax, you don't know how much it is or how to pay it, and you wind up on April 10th of this year, say, I owe $3,000. And in addition, you also owe the next installment of the next year's taxes. So you can get behind pretty quick.
Thank you very much for watching. If you would like to see more videos by California Lawyers for the Arts, please like and subscribe to CLA's YouTube channel so we can provide full-service live streaming programs soon. Our channel will be producing videos that cover all kinds of artistic, entertainment, and intellectual property legal issues. You can also find our videos on Facebook and livestream.com.